Just wanted to say welcome, everyone. Thank you for joining us today to explore paying for college basics. My name is Lorinda Diehl, and I'm joined by my colleague Jeff Lackey, who will be monitoring the chat, and we will also answer questions at the end of the presentation. And we are with Sallie Mae. We are excited to share insights that can help you plan effectively. We recommend that students start with that 1, 2, 3 approach to paying for college to maximize all your scholarships that you can find. Also, take a look at your federal and state aid programs before considering a responsible private student loan. Start with that money that you don't have to pay back. So if you have a student that is in high school, start looking for scholarships now. If you have a student starting in their undergraduate program, start looking for scholarships in the area to help you pay for your undergrad. I found out when I was in school that my professors sometimes knew a little bit about what scholarships were out there. And then if you are going to be attending grad school or professional school, also continue to look for scholarships. You'll also want to apply for federal and state aid by completing the FAFSA. And if you do have a remaining financial balance, research and consider a responsible private student loan. Scholarships are free financial aid award. This is money you do not have to repay. A scholarship might cover the entire cost of your tuition, or it might be a one-time award of just a few $100s. Either way, it is worth it because it reduces your cost of education. Wondering when you should apply for scholarships? Each scholarship has its own unique requirements that indicate who qualifies and how to apply. It also depends on the scholarship deadline dates. Some deadlines are as early as your junior or senior year before you start college. And many of them will let you know that, hey, you can apply while you're also in your undergraduate program. If you are already in college and maybe missed that opportunity to look for scholarships while you are a junior or a senior, don't worry about it. There are scholarships out there for you. Just start looking. Also, look for the information that will pertain to your situation. And the next question is, how do you apply for scholarships? Well, each scholarship has its own unique requirements because there are multiple donors out there. The scholarship website should give you an idea of who qualifies for the scholarship and how to apply. Make sure you read the application carefully, fill it out completely, and meet the application deadline date. In many of the schools that you will be applying for, they might have outside scholarships that you can take a look at, and also definitely take a look at your local high schools, community service centers. I even say go to a local library, and sometimes there are books there. And if you talk to your local librarian, they can help you find a list of scholarships that could pertain to you. The free application for federal student aid, we refer to it as the FAFSA. It is the first step in applying for federal, state, and institutional aid. It is perhaps the most important form you will fill out to determine your financial aid eligibility. The Department of Education opens up the FAFSA every fall on October 1st. Please mark your calendar to complete this each year when it opens. You can list up to 20 schools in the online application. Some financial aid awards are based on first come, first serve, so apply as soon as you can. There are two types of educational loans available. We are going to review them in the next few slides. And we're going to take a look at the federal loans, and we're going to take a look at private educational loans. Let's begin with that federal direct loans for undergraduate students. Upon completing the FAFSA, students will be eligible for one or both of the federal student loan programs, the federal direct subsidized and unsubsidized loan programs. The U.S. Department of Education has an annual and an aggregate limit on how much a student can borrow through these programs. So let's take a look at them. Your undergraduate borrowing limits are your first year you can borrow 5,500, your second year is 6,500, and your third and final year is 7,500. The undergraduate aggregate limit is 31,000 and only 23,000 can be subsidized. Also, there is an origination fee on these loans. These fees are subtracted from the loan prior to disbursement. However, the borrower will have to pay back the entire amount of the loan, including the origination fee. Schools receive the loan proceeds minus the origination fee, so the borrower does not get the full amount that they borrowed. And the reason why we make that clear is as you build out your plan of how you're going to pay, make sure you subtract that origination fee out because you're going to owe it, but the school's not going to receive the full amount. And you need to account for that. There are various repayment periods on this loan, anywhere from 10 to 25 years, and there are several deferment options, including in-school, economic hardship, military. You would just need to call your servicer to talk with them more. If students need funds beyond these, you'll want to weigh your options, including the Federal Direct Parent Plus loan and the private educational loan options. Let's jump into that Federal Direct Parent Plus loan. And this is for new borrowers starting this fall, the information on this slide. So if you are a parent and have a dependent undergraduate students, you can take a look at your Federal Direct Parent Plus loan. Let's go through this. Your student does need to complete the FAFSA. The student must be enrolled at least half time. This is a credit-based loan, and there is an origination fee that will be subtracted from the loan before funds are sent to the school. Repayment terms will depend on the total amount borrowed, and there is a maximum per student per year, and there is a lifetime amount per student. So let's talk about that. You can borrow up to $20,000 maximum amount per year. However, the lifetime limit is 65,000 maximum. So you want to build that into your plan. Maybe you do want to take out the $20,000 year one, 20,000 two, 20,000 the third year, meaning you only have $5,000 left in for the final year. Or you might want to reverse that and start with 5,000 in the beginning, or you could take the 65 and divide it by 4, but just kind of build that into your plan. With the Federal Direct Parent Plus loan, the parent is the borrower for the life of the loan. The student does not have their name on this loan, and you can't transfer it to the student's name. If a parent does apply for this loan and they are not eligible, a dependent undergraduate student may receive an additional $4,000 of unsubsidized loan. Let's jump into that federal direct loans for graduate and professional students. So before we jump into the slide, which talks about new borrowers, let's just address borrowers that might already be borrowing from this program or the Grad Plus program. So if a borrower has a direct unsubsidized loan made before July 1, 2026, while enrolled in a credentialing program, the borrower can continue to borrow under the current loan limits for 3 academic years or the remainder of their expected time to credential, whichever is less. So if you're on the call and you are in your grad program or your professional program and you've already borrowed from the Grad Plus, you can continue going on through that. But however, if you do have questions, definitely reach out to your financial aid office. They're going to be the best resource for you at this point. Let's talk about the new borrowers, students that are entering their grad program or professional program. If you are a borrower beginning July 1 or after, the U.S. Department of Education has annual and aggregate limits on how much you can borrow through these programs. The FAFSA is required and the student needs to be enrolled at least half time. Let's review the borrowing limits together. Graduate students can borrow $20,500 per year with an aggregate borrowing limit of $100,000. A professional student, there is a list out there. It's small. You're thinking medical school, doctor of osteopathic, veterinarian medicine, law school, just to name a few. You can borrow up to $50,000 per year with an aggregate limit of $200,000. Both graduate and professional student borrowers have a lifetime limit, including their undergraduate borrowing, of $257,500. Also, a borrower is charged an origination fee. These fees are subtracted from the loan prior to disbursement. However, the borrower will have to pay back the entire amount of the loan, including the origination fee. Your school receives the loan proceeds minus the origination fee, so the borrower does not get the full amount that they borrowed. Definitely want to build that into your plan. Borrowers are also afforded one 6-month grace period. Interest accrues throughout the grace period and is capitalized at the end of grace. Borrowers can pay the interest at any time up until grace and avoid interest capitalization. There are various repayment periods anywhere from 10 to 25 years, and there are several deferment options, including in-school, economic hardship, military. It depends on your situation. You can reach out to your servicer once you get to that point. Now let's talk about private educational loans. A responsible private student or parent loan is another source of gap financing. These loans are funded by banks and credit unions, not the federal government. A FAFSA is generally not required for these loans, and they are credit-based. The lender may review your credit score, your credit history, repayment history, and other information to determine if you qualify. The repayment periods and terms are going to vary from lender to lender, so we encourage students to do their research to determine which lender and repayment terms best fit you and your situation. Private loans can cover up to 100% of school certified cost of attendance minus other aid received, and because most private loans have a zero origination fee, there is no need to borrow extra to cover these fees. We did mention that these are credit-based loans, and that likely carries a different meaning for private lenders. Because private lending requirements are often proprietary, we do not have a list of criteria like we did for the federal parent loan. That said, private lenders will likely look for an established credit profile. Because of that, a third-party cosigner may be required, unlike the Parent Plus loan. A parent loan cosigner does not have to be a parent. Students may be required to be at least half-time enrollment, although there are some lenders out there that allow borrowers to just be that allows them to be enrolled less than half-time. Students will have to check with each individual lender. Students may be asked about a cosigner. You might be thinking, who is a cosigner? A cosigner is a responsible third party, so it can be a parent, grandparent, aunt, uncle, neighbor, whomever is in the student support system. Kind of think about like who is their biggest cheerleader, like who would be at graduation cheering them on and equally as excited for the student as the student is for themselves. The cosigner can be someone who is willing to come alongside them, the student, to secure the loan and would only be responsible if the student fails to meet that obligation. In many cases, lenders offer a cosigner release option after meeting certain requirements. Private educational loans offer fixed and variable interest rates. That fixed interest rate, it's established at the time of the application approval and will remain at the rate will remain at that rate for the life of the loan. A fixed rate has a certain appeal to consumers as they convey a sense of stability. Fixed rates may be most beneficial for loans with long lifetime. As you can see, if you are that person that loves predictable monthly payments, a fixed interest rate might be the one that you need to choose. A variable rate can change throughout the life of the loan, but the scale is established at the time of the application approval. Variable rates are more beneficial in a low interest rate environment, especially if the goal is to pay the loan off sooner rather than later. Several lenders use the Secured Overnight Financing Rate, SOFR, or the U.S. prime rate, with potentially an increase or decrease of that rate. Private educational loans typically do not have that origination fee, potentially representing a significant savings over that degree. So let's take an example of a $10,000 private loan, which has no origination fee. The school would be sent $10,000 to be applied to the student account. You could also look at a Parent Plus loan for the same amount, and it would incur a $423 origination fee. So you need to subtract that directly off that $10,000, and that's what the school would receive. The borrower would save $1,692 over the course of the degree if they took out the private loan. Repayment terms are going to vary from lender to lender, but can offer various repayment options to the borrower. That's just something you're going to want to research. They have in-school deferment. You can make interest-only payments while you're in school, or you can make a small $25 monthly payment. Some lenders may offer interest and principal payments while you're in school. And then the repayment options on the back here, how many years you have to repay the loan, differs by lenders. Most lenders do offer a grace period that starts once the student graduates or is no longer enrolled. Payment relief options like forbearance will vary from lender to lender, but most do offer something to assist borrowers who are struggling to make payments. That said, borrowers will want to contact their lenders immediately if they have any payment challenges. We provided a lot of information, but this slide just gives you that very high level side-by-side comparison of the two types of loans for you to reference that should help you along the way. Definitely want you to sit down, do your research. I love spreadsheets, just kind of putting on a spreadsheet what your options are to help you build a plan out of how you want to pay for school. One thing we want to touch on before we close is interest rates versus annual percentage rates. Comparing APRs when shopping for loans can help you make more informed apple-to-apple decisions. The APR is the cost that you will pay each year to borrow that money. It includes all the fees, repayment type, and loan term expressed as a percentage. The reason I bring this up is if you're looking at federal loans, they usually represent their rate in just a straight rate. Private lenders represent their rate with an APR, so make sure you're doing that calculation so you're comparing apples to apples. We've mentioned a little bit about origination fees, just wanted to highlight it one more time. An origination fee is a percentage of your loan amount charged by the lender for processing the loan. Federal student loans have origination fees. Therefore, the amount you receive when it's dispersed may be slightly lower than the amount you accept. Many private lenders offer zero origination fees. Please do take a look at the California Coast Credit Union's free wellness information, college planning, and financing resources to help you as you build your plan. I'm just going to let it sit here for just a few seconds so you can actually take a screenshot. You can actually connect the QR code so you can start digging into that information. And then let's jump into questions.
Jeff and Lorinda, thank you very much. That was a lot of great information. As a reminder to everyone, if you have a question, please put it in the chat. We can utilize this time right now, answer those questions in real time. So if you have a question, feel free to put that in the chat. We did have a couple questions come in. One of them happened to be a question on the definition of what is considered a professional student.
Yeah, Lorinda, I can probably take that one. So, the Department of Education back in 1965 passed the Higher Education Act. And when they did that, and again, this is an 80,000 foot high level view. They created some definitions between the various different degree and certificate programs as to what constitutes a professional or a graduate student. That has not deviated to, fast forward to 2026. The main parts of the Higher Education Act still apply to today. So a professional degree is going to be that as such, getting limited degrees in medicine, dentistry, pharmacy, law programs, veterinary medicine, podiatry, chiropractic, optometry, various different theological degrees. So if you think of like masters in divinity and such. And then, of course, there's varying levels of clinical psychology. And they typically have to be at the doctoral level in order to be considered a professional program. If your degree or certificate that you are obtaining at the graduate level does not fall within one of those fields, you will be considered a graduate student. And as such, from a loan perspective, federal loan perspective, will be limited to the 20,500 per year, $100,000 cap. But I do want to throw out that there are several groups and education related interests that are trying different ways and avenues to get that changed. But as of today, that has not.
Thank you, Jeff, for that question. Another question that had come in regards to it's a FAFSA question, maybe, and in regards to 529 plans. How should families strategically use the 529 and time those withdrawals to maximize aid eligibility and to minimize student loan debt?
Lorinda, do you want to take that one or do you want me to?
So I was gonna let you take it, sorry.
Okay. So 529s, first of all, my assumption will be that we're probably talking about a California 529. However, I know that there are exceptions to where some individuals can get on 529 plans outside of a particular state that you reside in. Typically, if you are the parent and the your son or daughter is the immediate recipient of that 529, chances are you are going to have to disclose the value of that 529 on the free application for federal student aid or the FAFSA. So from that particular aspect, there's a good chance, and because I don't do the federal methodology, I want to say that there's a chance that you may find having to utilize some of that 529 plan a little bit earlier in the educational journey of a student. So think of your first year or second year versus your third or fourth year. There's a little bit of a philosophy or of a notion in order to try and utilize as many of your own resources prior to qualifying for federal and sometimes potentially state aid. Having said that, the FAFSA federal methodology takes into numerous different aspects. They ask you, various different questions, and so what happens for you versus your neighbor may differ a bit. So, from that perspective, if the 529 is in you, the parent's name, and it's in immediate beneficiary as your son or daughter, you will have to disclose that up front. If the 529 is in a grandparent's name or somebody else's name that's a bit more extended, there's different provisions for that, and sometimes the full amount of that does not need to be accounted for on the FAFSA at the time of filing.
Hmm. Yeah, interesting. A lot of nuances to 529s.
Yep.
Another question in regards to applying for these loans. Do you do you need to apply every year for the amount that you need? And do you end up with potentially four different loans for an undergraduate degree?
Yes, so just the way it's written, every student has to apply for federal loans, especially you apply each year for that academic for the next academic year. So a student that is starting school this fall, they probably started filling out the FAFSA last year. And it is four separate loans. You can look at it that way, but for federal loans, they are given to the same servicer. And so all the loans are listed, so you'll receive one statement and you can handle and make a payment for all the federal loans at one time. For private lenders, when you look at that, it is also an academic year. And you can just look into the programs and see if there's ones that you can apply for now that covers all 4 years, but you're just going to have to do your research with private lenders. But it usually is one loan per year.
Excellent. Thank you. Another question is, how should families optimize borrowing across multiple children when they're attending college at the same time?
Lorinda, do you want to take another? You're closer to that
Well,
that
I was
scenario than I am.
Well, I was just trying to think of personal experience, and Jeff, I'm sure has some ideas too. And how we did it is we truly had a spreadsheet for each child, and just trying to determine that we filled out the FAFSA and how much, we just started listing down. Here's the direct cost. Here's the indirect cost. Here's what we're getting from the FAFSA. Here's, if we had some savings from work that my children had done over the summer, what their money we had saved. And we kind of just came up with a plan for each student. And in some cases, those plans were a little bit different. Schools do have payment plans available. We researched payment plans. We researched the Parent Plus loan. We also researched private educational loans. And to be honest, they were a combination of all of that.
Mm,
And so until I'm a visual person. I just think until you visually get it down on a piece of paper, or I used a spreadsheet so I could see what I did the next year, so I could always go back to it, which was very helpful through the years. And I also encourage my students, my daughter especially was able to find additional scholarships through her undergrad and her graduate programs, which helped a lot. We also really dug into those indirect costs and start thinking about, do you really need this or do you really need that? And just really kind of had that candid conversation with my students so they knew what was expected of them and how we were financing it, and to be very careful and try to use anything we can to help save money. So that could be used books. Some of them, it could be online books were cheaper than having the actual textbook in front of you. And also, once they get into school, both my students were able to talk with other students, and they kind of just give you ideas of how to kind of save along the way. Do you have anything else, Jeff, that maybe I didn't add?
No, not necessarily, but there was one small little philosophical thing that I was thinking about, and that is in regard to if you've got students that are decently close in age to where they would both be attending school at the same time for more than just 1 year, it is going to have to be a family decision. I know that finances are tight, inflation always is a concern, and so on and so forth. We always want to strive what we think is best for our son or daughters, and we always want them to be able to go to that school that they've hoped and dreamed in going to. But sometimes you may also want to research with the admissions office or whatnot if there is any additional aid available if the siblings attend the same institution.
mm,
You may also want to research all different types of institutions, 2-year community colleges, 4-year public, and 4-year private institutions. You may be
mhm,
surprised that what we typically think of as being a higher cost 4-year private might actually have some deeper discounts that they can apply for having multiple students at the campus. So I guess the end result I would say is simply ask the questions. Don't be afraid to pursue options. Don't limit yourself saying, oh, that would be too expensive, or I think my degree will be different if I attend this college or university. Just simply ask the questions, research it. They're, admissions counselors financially, they're there to answer your questions.
yeah, excellent. Thanks, Jeff. Another question here. I know we're short of time, but how do you decide, and is there a strategy for de determining whether the parent should take the loan or the student should take the loan? Are there any tax benefits, or what are the pros and cons of parent versus student taking on that student loan debt?
Sure. So that is going to be a personal family decision. We know that, during COVID, there was a lot of movement around the United States, and now, a year or two, a couple of years later, we're looking at folks having to relocate closer to businesses and whatnot. And so, therefore, having additional debt on a parent's account, credit account, might limit their options and where and their flexibility in moving various different areas. Subsequently, if it's taken out in a student's name, many lenders don't care necessarily where the payment's coming from. If mom and dad want to help the student with that payment, as such, being a cosigner, of course, Lorinda explained some cosigner releases. So there's some benefit there if a parent does not want to be on it for the entire duration of the loan repayment term. But it's going to be a family decision and a family call
Mm.
on that. Regarding interest, or excuse me, tax breaks, we always encourage students to go out and families to go out to irs.gov, Google publication form 970. That is going to be all the different various education related tax breaks each and every year. Typically, IRS does not publish those until sometime in the fall, so it's hard for me to speak to various different incentives right now because they could change. So we always encourage going to irs.gov, look up publication 970 and kind of do that breakdown, or meet with a financial consultant or tax consultant on your options. We're certainly not tax advisors, so what we are offering is somewhat of an opinion.
Jeff, Lorinda, thank you so much for all this information. We truly appreciate it. And those that you were in attendance, thank you for taking the time today. Until we reconnect next month, we wish you continued success on your path to financial well-being. See you again soon. Bye.